what is a DPO, and why is it one of the biggest wealth drivers in real estate right now?
Yeah, so a DPO, it's a huge term right now, and we are exercising a number of those for opportunities right now. But what it's a discounted payoff, and so it's when you get to step in and you start negotiating with a bank instead of the owner or seller of an asset. And maybe for Brian, you can probably talk about this as well. For simplicity purposes, it's almost like a short sell in owner occupied houses. You always hear about, 08, 09, we had the subprime crisis and you had all these foreclosures. Well, before a property goes to a foreclosure, the lender has already stepped in and moved that asset from a performing loan to a non performing loan. Maybe the occupant has not paid their payment in 2, 3, 4, depending on the state, 6, 8, 10 months. And so now all of a sudden you've got a lender that is motivated to sell that loan. And when they sell the loan, the asset's going to go with it. Or they may just sell the asset to get rid of the loan altogether, depending on what the buyer that they're looking at is negotiating. And in those circumstances, typically the bank takes what they call their REO schedule and they'll go to market with it. They'll work with their investors that, Boone, this is how you and I got started. Being my background in private equity, I had relationships with a number of groups that bought banks. And when they would buy a bank, they would bring us their REO schedule and say, hey, these are the non-performing assets that when we acquire this bank, we're discounting the purchase for these. We want to dump these day one. And all of a sudden, we've got a list of properties that we can step in and buy. Well, those are pre-foreclosures. Bank hadn't foreclosed and stepped in and taken the property to an auction at the courthouse steps. They are negotiating with possible buyers at that point for a discount. And let's say, so you move that into the commercial aspect. And I talked about this a while ago. Let's say you've got an owner that bought a property for $18 million. They put $2 million in it. They're all in it at $20 million plus closing costs, maybe almost $21 million bucks. And they got a $15 million loan. Maybe they over leveraged a little bit because they were getting really cheap debt at the time, low interest rate. They got a $15 million loan and they brought $7 million of their own capital into the deal. And all of a sudden, their cash flow is not covering the cost of debt, or it's at the end of the original term and they have to either refinance or sell, or lender is stepping in and exercising on lender required repairs, and operator has not had enough cash to manage those repairs. And so now the lender is putting pressure on the operator and working on potentially taking the asset back. Well, with real estate, specifically large commercial sized real estate, operators tend to fold more quickly and they just walk away from it. They can't deal with that headache. And so then the lenders come to operators like ourselves and say, hey, we've got this asset. It's worth today 17, 18, 19 million dollars. Operator has 20, 21 million dollars in it. We've got a $15 million loan. It's already been moved to our REO schedule. It's bad debt. We've written it down, and they're willing to take $12.5 million for that $15 million loan. So now we're able to step in and not only buy well below replacement value, but we're buying below the cost. We're buying below debt at that point. Creates a huge upside opportunity there for that, what is called a discounted payoff, or DPO. And so that DPO becomes free equity to us.
Well, and it really resets the market.
Good
You're
point.
resetting capital stacks, you're resetting basis, and resetting the purchase market. And so yeah, I think it's a
It's to that point. It's a tool that Donald Trump used in the late '80s and '90s.
yeah.
And there's we've done this. on some of our own assets as well. So we're looking at assets from other operators, but we used it as a tool. We took a couple of assets into a Chapter 11, tied it up so that it forced a bank to come to the table and negotiate, because we can then argue you're writing this debt down. If you want to take this property, you're going to sell it for less than the debt that you have. So let's renegotiate our debt that we have for more than what you would be selling it for if you took this property and went to the open market. So go back to my scenario where we've got a $20 million asset with a $15 million loan on it that the lender is going to go to market and they may sell it at $12 million. Well, we'll step in and we'll negotiate down to $13 million. So we get $2 million of free equity. We reset the basis on the property. We reset the tax calculator as well. And we've reset market now, and it makes it easier for us to go negotiate with other banks at that point because our bank has already taken a discount.
But so you mentioned, one of the things we're doing right now is obviously we've taken some assets into bankruptcy to force negotiations with the bank. So many people hear that word, put negative connotation to it when it's just another tool in if you're an effective business person, it's your tool belt. I was talking to a judge one time, and I used that word, and he got all, oh, you've done bankruptcies before, and I was like, well, yeah, it's no different than you saying the word judgment or something like that. It's terminology they hear every day. It's terminology we hear every day, and a tool that we know how to utilize. So I think that's an important thing to
Yeah, I mean,
note.
I think there's a perfect example. We was talking with one of our investors in basically an equity group that they specialize in taking assets of their own into bankruptcy and or stepping in and partnering with groups that are taking an asset into bankruptcy. Because when you do that, if you I've read all of the Trump books. I've read I don't know how many real estate books on utilizing a Chapter 11 bankruptcy as a benefit to what you're trying to do. And so not every scenario works out that way, and it also costs money to go into bankruptcy. You've got to have some liquidity to go into bankruptcy. People think, well, I don't have any money, I can just throw it into bankruptcy. No, it doesn't work that way. First of all, you got to pay your attorneys. You've also got to pay the lender's attorneys during that time. Like you agree from day one, you are paying for the lender's attorneys from day one. So there's $250,000 out the door immediately for both sides of attorneys. Then the court charges for bankruptcy, and you're not just going to walk out of bankruptcy not owing anything. You're going to have to pay to keep the asset in bankruptcy. You're going to have to keep the property up during bankruptcy. And then you're going to have a negotiated settlement coming out of bankruptcy where you're going to have to pay that lender off. Maybe you had a $15 million loan and you're only paying $12 million. New lender coming in is not going to give you $12 million. It's going to be $8-9 million. You're still going to have liquidity. And so it's a tool to buy you free equity, but you've got to have the capital to do it. And so it becomes a very, very, very useful tool to, like you said, reset that capital stack and buy some free equity.